Hi there, it's Victor here. Hello, ladies and gentlemen, boys and girls. Welcome to another session of how to grow your wealth. Today I'll be talking about index fund. You know, when I started with stock exchange for beginners, my next content was supposed to be the ways to trade in the stock market, which is the day trading, the swing trading, and the long hold. But 80% of the calls and concerns that I received in the comment was regarding mutual fund, which is a long-term holding. So that urged me to talk about mutual fund. And after talking about mutual fund on the previous video, I decided to move it one step further, which is index fund. So today, we will be talking all about index funds. So to fully understand the concept, I'm going to break it down into a couple of sections. So we'll talk about what's index fund. We'll talk about the history of index fund. We'll also talk about the market index, because that's where the money is, Show me the Benjamin, that's where the money is. And then finally, we will also go ahead and talk about a practical example or a practical concept with index fund. Okay, so what exactly is index fund? Index fund is simply a type of mutual fund which tracks or which mimics or which mirrors or which shadows a market index. Now, hold on. You see, we use all these financial terms like shadows, mirrors, mimic, but in the simplified term, an index fund, it's simply copying an existing market index. We're going to talk about market index later. So for now, just understand that an index fund, it's a type of mutual fund with two main differences. The first difference is that it is not actively managed. That's why there is very less or little fees. The next option is that there is less risk because it actually tracks the performance of an existing market index. And this market index is created by the best business analysts in the world, the best investors in the world, the best financial planner. So which means it will always perform. It's very difficult that a mutual fund will overperform an index fund. So that's the basic definition. The simplest mode, it tracks the market index. So now let's talk about the history of index funds. Anytime I watch on the TV and I see graphs and data that I don't understand about mutual fund, index fund, and ETF, sometimes it gets me so confused. So that's why anytime I want to talk about index fund or mutual fund, I like to take it back to the history. So now let's talk about the history of stock market. Stock market started like over 100 years ago, and it started in the streets of New York. What happened is that when people wanted to buy stocks of company, they would go to Wall Street. They would meet all those guys walking around with briefcase to be a middleman between them to buy the shares. And then after a while, people are like, why should I have to go to New York all the time? Can I not just buy it somewhere? That's when the platforms came in. You have brokers. That's when Vanguard came in. I don't know if you remember about BlackRock. BlackRock also came in. Those were platforms that you will go in and then buy stocks and shares of different companies. So they decided now to have those platforms in different states and provinces. So New York will have one, you go to Maryland will have one, you go to California will have one, Texas, you come to Ontario, British Columbia, they all have one of those trade platforms, which we call them brokerage. So at that time, it was only individual stocks. So people start complaining, if I buy one individual stock and it happens to dip, I lose money. Why can't I just have all? That's the point where mutual fund comes in, because it's diversified. When mutual fund came in, it's all actively managed by portfolio managers. They were making a lot of money. All the financial institutions were booming because it was actively managed. Then came Vanguard. The person who founded Vanguard, John Bogle, His aim to found Vanguard was that he wanted to put money back into the pocket of investors. But now with mutual fund taking all the monies from the investors, it was kind of defeating his purpose. That's why he invented index fund. The reason he brought index fund was to put money back into the pocket of the investors. By the way, the founder of Vanguard, John Bogle, may so rest in peace, he passed at the age of 89. What he did was that he decided to come up with the index fund, that instead of you paying all this money for mutual fund, why don't we create this index that everyone will buy a fund that will mimic or copy this index, and it will be passively managed and they will still make money. So that's how index fund came in, and it's been around for over 40 years. I will drop an article here from Investopedia explaining the evolution from mutual to index fund. So if you are making money through index fund or exchange traded fund, then kudos to this guy, because he is the one who actually came up with index fund. Now let's move to the next section, which is the market index. Well, the market index, which I mentioned earlier, it's simply a hypothetical portfolio. It's a measure of a section or some companies within a particular stock exchange. It doesn't really exist. It's like a ghost or a BS. You didn't hear that from me. A BS, what I mean is that it's like blue sky. You cannot see it, you cannot touch it. That's what a market index is. So business analysts, they sat down in every stock exchange. You go to, in the US, in New York, you have the S&P 500, which is the best 500 companies in the US. When you look in the portfolio, you will see Berkshire Hathaway, Johnson & Johnson, ExxonMobil. Then you go to London. On the London Stock Exchange, you have the FTSE, which is the Federal Territory Stock Exchange. You have the Tesco, the Asda. You go to Japan, you have the Nikkei 225, best companies in Japan. You go to Hong Kong, you have the Hang Seng. You go even to India, you have the Nifty 50, the 50 best companies. They put it like a measure that other companies can measure. You come to France, you have the CAC 40 or CAC 40, which is, the stock exchange index in France. You go to Nigeria, you have the NGSE, Nigerian Stock Exchange Index. You go to South Africa. South Africa kind of mimics the FTSE from London Stock Exchange. So the FTSE GSE, which is Johannesburg Stock Exchange. And then you come to Toronto. Toronto also mirrors out the S&P. So you have the S&P/TSX, which is Toronto Stock Exchange. So that's how they came up with all those market index. So what happened is that you don't go to a broker and say, I want to buy an S&P 500. You cannot buy a market index. They're going to laugh at you like, what are you talking about? So you buy a fund which simply mirrors, it copies. So it looks at what is in S&P 500 and it copies it. You go to UK, you look at the FTSE 100, you look at it, it has Tesco, it has Asda, you buy it. You go to South Africa, you look at the fund of the Johannesburg Stock Exchange Index, it has Jasper, it has MTN, you buy it. You go to Nigeria, you look at the Nigerian Stock Exchange Index, you look at the company, there is Glo, there is Dangote Group, wow, this will always perform. So you buy something that mirrors, that copies. So that's how it works. I'm going to drop an article right here which will give you like the world indices on where, if you are everywhere in the world, you don't have to buy and hold or passively, you just metrics. You follow the metrics, you follow the market index, it gives you the return, and if it's dividend paying, it also gives you the dividend. So that's an easy way. So we've talked about what's mutual fund, what's index fund, what's the history of index fund, market index. Now we're going to talk about a practical scenario, how to make money, because the purpose of this video is make money with index fund. Now, according to Morningstar, which is an investment research firm, the average fees of a mutual fund is between 1 to 5%. Well, it ranges from 1 to 5%. But let's just say 2.5%. Okay. You're paying a fees of 2.5% per annum. That's annually. For example, if you invest, let's say you invest $10,000. What's 2.5% of $10,000 per year? That's what, $250. Which means the $250 that you are paying for that fees would have been eventually going into your coffers. So instead of making money, you are losing money. While with index fund, there is little or no fees. On average, the fees of an index fund is 0.04. I'm going to show you a graph right here from Morningstar, which shows Fidelity, Vanguard, Questrade, all their index funds are right underneath 1%. It doesn't even touch the 1% margin. It's around 0.05 on average. So the first way that you can make money with an index fund is because you will save the money that you would have been lavishing for fees. So now let's head over to my desktop. Let's do a scenario because I have some software to show you how you make money because of the fees. So right now I'm in front of my desktop and I'm just trying to check and do some data analysis, trying to compare actively managed funds as well as passively managed funds. So I'm on the website of Questrade. So this is Questrade website. Questrade is an online Canadian broker. So just like I said before, they have a simulator which you can compare which funds you want. So here we have actively managed fund, which is mutual fund, as well as Questrade portfolio, which is not actively managed. So I have, let's say I put $10,000. Well, by the way, let me even out. I'll take it down to 0 and let's see. So 0, you see it all evens out. Now let me put in $10,000 and see what happens. With time, for a period of 10 years, with mutual fund, 10,000 will be what? 18,000 and change. With, the passively managed, it's 22,000 and change. So you have almost $2,000 gone just for fees. So this is just analysis, but you might want to do your research yourself. You can go to all these sites, Questrade or any other trade or any other trade company will, have an opportunity where you can compare and contrast. And next, let's move on to Yahoo Finance. We talked about all the different well indices. So you have S&P 500, you have Russell 200, you have FTSE, you have Jakarta. So you have all. So you can go to this website and you'll get information on most of the well indexes. Last but not the least, let's go to a comparison between Fidelity index funds and Vanguard index funds. So I'm more interested on the fees. I don't care about the minimum or the amount to start up, but look at the fees. What I said before, the fees ranges from 0 to like 0.015. Look at Fidelity, 0.015%. This is a comparison, the expense, the management expense ratio. See how low it is as compared to 2.5 or 3% on actively managed funds. So I just said, let me show you this 3 website. It's all live. This is active. I can come here. I can change it to, let's see, 100,000. See what happens. The more you go, the more money you could have saved by just avoiding one particular fund because of the fees. Okay, so now let's hop back to... Okay, so I'm back at my station. So you see, I create this content as educational assistance to guide people getting into investment venture. Because when it comes to investment, there are 2 principles. Knowledge is power, and watch out for the fees because the fees do matter. That's why I always, reference some books that you can get knowledge to build up your investment portfolio. So if you are new here, consider subscribing and wait. Also press the bell notification to be notified anytime I upload a new video. And for you to be able to subscribe, I think you have to log into YouTube with a Gmail, something like that. Okay, so now let's move over to the second point on how to make money with index fund. You see, because index fund simply mirrors or shadows or mimics a market index, there are chances that it will always perform well. It will always perform well. According to Morningstar, 96% of actively managed funds underperforms the market index in that sector. Now, what does that mean? That means funds that are actively managed, like mutual fund, they don't even perform the S&P or the FTSE or the Nikkei or the Hang Seng. They don't even perform them. So why go with a fund that will charge you high for fees and will still not perform the market index? So that's the two ways. We've already spoken about the first way, which is fees. The second way, which is, you track the market index, which gives you more point. And last but not the least, if you even want to make more money and it even get better, is to choose an index fund which is dividend paying. When I say dividend, which means some companies pay back their shareholders for their loyalty. Some of the dividends even rise from 0.5 right up to 1.5. Let's say even 1%. Let's say you have $10,000 in any portfolio. What's 1% of $10,000? $100. So every month you'll be making $100 dividend. How does that sound? That sounds to me like that's what I need. Show me the money. You know what I mean? So you'll be making money for appreciation, which is equity. You'll also be making money from dividends. So that brings us to the end of this session. If you like this video, share, comment down below. Let me know how you're performing with your stock exchange journey. Question of the day: do you have index fund? Do you have mutual fund? How is it performing? What's the return over investment? Leave me a comment below, please. I would like to know, and also leave me the symbol of your fund so we can know how to, develop ourselves and try to better ourselves when it comes to investment. Until then, I'll see you in the next video. Thanks for watching, and please don't forget to subscribe.